Welcome to another real estate industry update. I'm Daniel Roccanti here with Kyle Paxton. Today, we're going to talk a little bit about investor management and more importantly, how to get those timely K-1s that all investors want. Um, if you are into real estate, investing in real estate, at some point, you're probably going to want to expand. And by expanding usually means bringing on investors. That means you can start doing bigger deals, buying bigger real estate. It can mean greater returns. It can mean a lot of wealth. But in the same time, it also means a lot of complications. Okay. Bringing in passive investors is just more complicated in general. Your tax return's more complicated. Now you have investors that you have to make happy constantly. And one of the things that you always need to worry about every year is your investors are going to want your K-1s timely. They do not want to extend their returns. They're going to need it with plenty of time to file their tax returns by April 15th. So, Kyle, why is timely K-1s matter so much?
Yeah, so when we're talking about timely K-1s, we're talking about all shapes and sizes of real estate business here, right? It can be family offices, just a couple partners. It can be your syndication funds with 100 partners plus, right? So this problem takes all different kind of shapes and forms. And the number one thing I hear from investors in syndication funds I work with of their like primary concern of what they're getting out of the fund is this timely K-1 delivery. Of course, they're assuming that you're going to deliver on the promises on the return, everything like that. But on the average year, the average day, the biggest thing they want is when am I going to get my K-1 and when can I file my tax return, right? So not only is it a compliance issue in terms of you actually have to file a tax return by the deadline, right? You have to file a federal return. Sometimes you have state and local tax issues. Depending on where you hold property, where your GPs or other investors are located, that can trigger different filings, different deadlines. So you have the compliance piece, but also it's an investor relation problem, right? Um, in theory, to Daniel's point, you're growing, you're going to continue to do deals. Maybe the end of this deal results in a like kind exchange where we're rolling into another deal, right? You want to keep your investors happy because you want them to come back to you generally, right? So you want to build that, you're a trustworthy place to put your money. And a big way to do that is to just show you're doing your job timely, right? So it's a stress and complication mitigation, more than anything else. I think another thing that it shows is, when you prioritize your K-1 delivery, you're demonstrating kind of transparency and reliability, right? You have a clean set of books that you're issuing to your CPA. You've done planning on the front end. All that process goes smooth, and you give your investors plenty of time to actually review what they received in terms of K-1, compare it to what it was promised to them at the beginning of the deal, what their understanding of the operating agreement is, all that good stuff, and actually make informed decisions around their tax picture instead of giving them a K-1 on April 15th and expecting them to file on the deadline. That just creates stress for all parties. It creates stress for investors, CPAs. It creates stress for me if I'm, the CPA of the operating partnership. So it just across the board eases some stress.
Yeah, and I'd like to highlight like one of the things that you mentioned here was just trust in the investors. Especially if this is your first deal. Yes, all your investors are trying to make profit, but there's a lot more than just profit. Transparency, getting their K-1s on time. And if you can make it a great experience for them, they're going to keep coming back. This isn't going to be their last deal. If everything went smoothly and they made profit, you almost can guarantee that they will invest in your next deal as well. So doing a great job here has actually like infinity times basically rate of return if you're doing it right, just because it has so many more potential down the road. So getting this right, especially if it's your first time, is really important for your future here in the real estate.
There are very few things more frustrating in my world than having a beautiful individual tax return done on, we'll say March 15th, right? And then we're sitting on that thing till October 15th while we're waiting on, one straggler K-1 to come through. And I know that that return doesn't take that long to do. And, the books are organized, it should come through cleanly. So, I'm putting that word in my client's ear too. If I'm on the, limited partner side or whatever, hey, um, there's some red flags here, right? We could do this a little bit quicker, and save everyone the trouble. So, Daniel, can you speak to a little bit kind of how maybe you can streamline that record keeping process and keep things moving just a little bit faster?
Right. So the most important thing is if you're trying to get this tax return done timely, is basically you need good record keeping and good data collection. Okay. This is bookkeeping, most importantly. Okay. Not just bookkeeping, but bookkeeping. If we do not have good numbers, it's going to be hard to get you a tax return quickly. Okay. And so it's really important that by the end of the year, you basically have your books done and ready to go as soon as possible, and that they're of a high quality so that it's smooth to get your tax return done. You've got a messy books, that's going to make things more complicated here. The size of the entity matters a lot. So the bigger the investments are that you're doing, the complicated, if you got tons of different rental properties, if you got one or whatnot, like all these things matter, how complicated your return is. You want to basically make sure that you're just keeping really good books and that they are ready as quickly as they can be after the end of the year. You can do a lot of things before the end of the year to get ready for that, basically. Okay. By getting ready, like before the end of the year, making sure you're reconciling your books, everything every month or whatever. And then when the year run comes around, get them really quickly done in January. Okay. um, using certain accounting software, certain things like that can help out the process, so you want to make sure that you're doing your research on what is a good accounting software. If you're doing it old school style with like pen, paper, or maybe even just using Excel, that might be a little tough for you, especially if it's a large investment. I do see those every once in a while, and I'm always surprised. Okay. And then make sure that you are updating and completing your cap tables. Okay. With these basically these syndications and these funds, you have investors. Okay, these have to get reported on the tax returns. All right, especially the first year. The initial year is really important, but there should be some kind of cap table that has record of all the investors that are in it and all their information. Okay, addresses. This needs to be updated annually. So at the end of the year, you should basically be reaching out to all your investors and saying, hey, if there's an address change, you need to live it because this has to be on the K-1s. Okay. There should always be social security numbers or EIN numbers, what type of taxpayer it is. Most of the time it's individuals, but it could be trusts, retirement accounts. It could be other pass-through entities. Okay. If it is a pass-through entity, there's more questions to be involved. Like, is it a disregarded entity? Like some of this stuff you don't even always know. You should be talking to your CPA about this. That's a big one. If an LLC is ownership in your fund, we're gonna be asking, how's it taxed? Is it a partnership? It's an S corp? Is it a disregarded entity treated as a sole proprietor? There's a lot of information that has to be on these K-1s that might not even be aware of, especially the first year. So it's just it really makes sense. Make sure this is completed before the end of the year. Okay. And it's updated completely so you can get it to us when you get the financial information. And if there's ownership changes, that also needs to be on there. Okay. Not all funds have a lot of owners coming in and out, but if they are coming in and out, that has to be recorded. We need to know exactly when the ownership happened. There's probably some kind of proceeds involved in it. This is all stuff that makes tax returns a lot more complicated, and we need this information as soon as possible so that we can get it done for you. Another thing is if you are taking on investors, please have them all fill out a W-9. Okay. The W-9, yes, W-9 gives you all the tax information you need so you know how to basically uh, do the K-1s or have us prepare the K-1s for you. Okay. And then if there's any changes, again, even though they filled out a K1, a W-9 the first year, we still should need to be asking for it, because people move, happens all the time. We just need updated addresses and everything. So it really hold a return back. God, I can't tell you how many times where we have the entire return done, but we just cannot get an updated cap table, and it really holds a return up. Now that you have good books and you have your cap table and everything, the next step is kind of like, hey, you need to get to your CPA so that we can get it done. So Kyle, why don't you talk a little bit more about like actual timelines, how that kind of works here with the CPA firm so you can get your K1s timeline?
Yeah, this is huge. So it gets back to the trust thing, right? So we have a triangle going here, right? Where you have in talking syndication fund setting, you have your GP operator of the fund, you've got the CPA, me, and then you've got your investors and the third prong of the triangle there. We all have to be in sync on timeline, expectations, all that good stuff to mitigate headaches, right? So what a timeline might look like for this is, you may think it's like, all right, give my books to CPA, we crank out a tax return in 2 days and go, everything's good, right? In reality, that's not how it happens. So what this might look like is, we're recording this video in November. So right now, in kind of like the October to January timeframe, we're in initial planning and data collection. So operator and myself get together and we have, maybe a kickoff meeting of sorts of, hey, here's what the 2024 tax year is going to look like, right? Here's new entities I have. Here's the different, to Daniel's point, ownership changes, new property acquisitions, things like that, refinance. Here's the big ticket items, the big activity we had this year and things to expect. That allows us to really lay out all the planning, right? For new entities, we can go ahead and set up that cap table if you have good record keeping. We get the HUD statement for property acquisitions. We can start kind of doing the depreciation calculations. If you are having a cost segregation done, do it now. We can get the detailed breakdown of the assets, start, getting all of that populated in our software. So then really what it is, we may be just waiting on the December financial statements. We have activity from January through November. The books are clean, kind of looking backwards to prior year. All of that is set up. So we're just waiting on that last month or two of activity to crank out the return. Real estate's a cash business. Most of these tax returns, the actual, like income and expenses are not that complicated, right? And so, we usually, in most real estate partnerships, we should have what we need in January, February to crank out the return, right? So, from my point of view, our busy season is March and April. That's our busiest concentration time, right? We can get out in front of that a little bit with a lot of these real estate partnerships to where my team has more capacity to turn things around more timely and all of that. So that initial planning is huge for that. So then when you're in the January, February timeframe, you start just doing those preliminary calculations and kind of that draft of the tax return. We'll have another video. We have another video available on operating agreements and things to consider there. But that is a big bulk of the work that we're doing, and your real estate partnership tax returns is reviewing the operating agreement and making sure everything's in conjunction with that. Moving that timeline up gives us a lot of time to make sure all of that is shored up and good. So that February, March timeframe, we get draft K1s together. You can start talking to your investors on here's kind of what we're seeing from a tax perspective with our fund. And then, late February, March timeframe, then we start saying, okay, here's our final adjustments. We have a back and forth. Anything we missed that you didn't tell us about, or, whatever, we make those final adjustments, can start issuing final K1s and distribute them to the partners. Then we still have to have usually a grace period where the partners can review it, right? To Daniel's point, there may be address changes, maybe there's other changes. There's disconnects in what the partner expected versus what is actually reflected on the tax return. We have to hash out, and not doing that on April 14th is so much better for all parties involved. So then again, you're looking at that February, March, early April timeframe to do all of that. And then you're finalized it done. Your investors are happy. They have a couple of weeks to finish their return, assuming that they're not, extending into the October timeframe. And then, if you have to end up making any cash distributions to cover tax liabilities for your investors or things like that, again, that gives you time to kind of arrange that activity.
Yeah, it is really important so that GPs and people that are managing investments here realize that like it takes time to finish these tax returns. Okay. And it's probably obvious you're not our only client. Okay. So we're not waiting around for just your information and then we can do it immediately. We have a lot of work, especially during tax season. We're all working plenty of hours. Hours is not the problem until during tax season. But your investors are most likely going to want their K1s by April 1st. Usually before April, better. Okay. And it's because, again, then they got to get the K1 and they got to get that to their CPA to prepare their tax return. It's going to take a couple weeks. Okay. Earlier the better. So if you can get your tax returns done by March 15th, give them a whole month, they're going to be really happy. But how do you get something done by March 15th? You basically have to get all the information to us by early February. The kind of the rule is it always takes a month to do your tax return. Okay. And if you're doing the type of tax return that has investors, it's probably on the complicated side, especially if you got states, especially if you got crazy allocations you have to do. You talked a little bit about operating agreements, but if your waterfall is crazy, like that takes time. Okay. These are not simple returns. We'll need all the information in the beginning of February, so that way we can basically go ahead, get this started as soon as possible, so that we can get it done by March 15th. But we need everything. So again, if we talked before, you give us great books, but then at the end of the day, it's like, hey, I'm missing your cap table. Okay. That's going to delay getting you your tax return and your K1s. You mentioned this a little bit, but a really significant one is third party reports. Okay, if you're getting a cost segregation done, a 179D study, any of these advanced tax strategies usually require some kind of study. That's a third party that gives you a report. All right, if you need that report, it takes them time to create the report and everything. So you should probably go ahead and try to get those reports well before you're needed. All right, if you're like, oh, I need a cost segregation, and January, February rolls around, well, they're probably going to take the people who do the cost segregation study some time. So now your cost segregation study is coming in late. And unfortunately, we can't even finish the tax return because cost segregation study is a pretty big deal when you're talking about real estate with all the accelerated depreciation. It's a big change to your return. So you're stopped at a pretty early point in the return. Okay. And so we can't even complete half of the return yet. We can't complete the states. We can't complete all the allocations and everything. So it can be a big damper on when we get this. So make sure that if you're getting third party reports, you're already thinking about this. Hey, when do you want a cost seg? All right, you should probably be thinking about it before the end of the year, talking to them when the timely. There's a lot of people who get cost segregation studies during tax season. Okay, the people that create these studies, they get backed up. So a lot of times they have their own deadlines, being like, if you don't give me this information by so, it has to wait till after tax season. And then you got to have the really, really difficult conversation with your investors that, hey, we're going to have to extend the tax return. Okay. And no, there has to be a really, really good reason. Like, hey, there might be huge tax changes to bonus depreciation. Hint, hint, that might happen. And so that's going to really affect the tax return. So we might hold off. And at that point, you need to be having early communication. You need to talk to your investors why that's important and get them on the same page with them. Okay. Um, Next is kind of like make sure you're utilizing kind of like technology and automation tools. Okay. There is a lot of software out there from bookkeeping to investor management to cap tables. Now, with the rise of AI, there's even all that. So, try to use these tools as much as you can so that you're trying to automate the process here, okay, for you as easy as possible. A lot of this information can just be gathered so much easier, sent to us in a very easy form. And so it's always what's the best tools. If you're just updating an Excel file all the time, maybe that's fine, but you got to be on top of that. Okay. And you have to do it manually. So you're trying to go out there, finding these tools will really speed up the process, reduce even potentially errors. And then at the same time, give us the information sooner so we can deliver these K1s and everything. So I always recommend going out there, seeing what kind of software is used, especially if you have tons of investors. If you got like 10 investors, not a big deal. If you got hundreds of investors, like put the Excel down, go out, find a good software. You're investing in a huge real estate already. So there's a lot of money being tied up in here. You can spend a little bit extra money on some good software. It'll make your life a lot easier.
And if I can add to that quickly, uh, generally your top flight CPAs in this space are going to be heavily invested in technology. Our firm does an incredible job of keeping up with. I mean, it seems like every 10 minutes we're exploring what do we need to do to optimize our technology stack, right? And so something I really appreciated, in prospective client calls recently, are very big on our prospects have to be a two-way fit, right? You have to be a good fit for our firm, and our firm has to be a good fit for you. When I have a prospect who's asking me detailed questions about our technology stack, that is a great sign for me because that means that's something you care about too, and you're using it on your side, and you're able to kind of keep things moving timely, and you're optimizing these processes in a way you can. So that always makes me a little bit happy when we're going through those types of calls when clients show interest in that. That's a kind of one of my little plus ones, right, in determining whether we're a good two-way fit, because it certainly helps expedite all of those timelines. So that is, yeah, definitely.
It absolutely does. And one other thing is we can kind of mention this, like make sure you're kind of reaching out to your CPA at the end of the year. But if you really want timely K1s, it's a year-round thing. Okay, you need to be updating, looking at stuff, doing a mid-year review. Okay, really encourage that, being very proactive. Quarterly, getting this stuff updated. If you're waiting to the end of the year, it accumulates a lot of stuff. It can be a lot for you. All right. So we always recommend being in contact with your CPA year round here. Just being like tax returns done. Great. Now the next one, we're getting ready for the next one. Let's start in the middle of summer. You can have a little bit of a break, but let's go ahead, start getting ready for that next one coming up. Make sure you're talking to your CPA, especially about big things. So like Kyle, what are some other things that you've seen with like kind of like a mid-year or some kind of, throughout the year review?
Yeah, we've touched on a lot of kind of the mid-year check-in things already, but a couple things I want to re-emphasize here is in preparing a real estate partnership tax returns, the starting point is the operating agreement. And I'm using the term operating agreement. Generally, these are organized as LLCs. It may take different forms depending on your entity structure, but in an LLC, you have operating agreements. So doing that mid-year review really gives you the opportunity to sit down and making sure kind of the economic activity is aligning with what is outlined in your operating agreement. And if any adjustments need to be made, you need to make communications to your investors on, hey, we're setting up to where there's going to be special allocations needed and income may look a little different this year. All of that is much easier to talk about in the September through December timeline than March or April 15th, right? So getting in front of all of that, we've talked several times now on just keeping your books updated, updating your cap table, all of that kind of stuff. Real estate's a cash business. It's a cash flow business. And so stopping and taking a look on what's our cash flow looking like relative to expectations, what distributions are needed based on that operating agreement, having your CPA kind of look over your shoulder and double check all of that. Great practice during the year. And then, just a broader look at our tax positions. We are in a political year at the timing of this filming. We just passed a big election here. So this is a great time to sit down on. Daniel joked a little bit about the bonus depreciation hit. Changes are coming. And so, sitting down and making sure you're well positioned for that, especially if you're intending to sell here in the short term, the underlying property, getting an understanding of any tax law changes that may impact that is super helpful. And then I want to emphasize one more time, communication with investors and making sure everybody's on the same page. And all of that is received much better during the year than it is on April 15th.
It really is. So kind of a quick summary here is basically make sure you're having good bookkeeping, good record keeping. Make sure you're getting those cap tables updated. Okay. And like how we just mentioned, it's a year-round thing. Okay. So make sure you're doing this year-round so you're not waiting to the end of the year. Okay. And if you got complicated matters, make sure you're talking to your CPA well in advance before it. Tax year is the most busy time of the year for all CPAs. So there's tons of clients, we're working late hours. So if we can do it outside of tax season, it just makes everything a little bit easier for you. Okay. We talked about deadlines. Make sure you're meeting those deadlines. Talk to your CPA in advance. What's the deadline? When do I need to give you the information? They're going to need at least a month. So most likely your deadline, no matter who the CPA is probably going to be February 15th or earlier. Okay. That's kind of a good tip there. And I'd always recommend even earlier than that. Let's get them in that early February. Make sure you're using the correct technology tools out there. They're always changing. The bigger the investment, the more likely you need to be looking at tools that you can use. This will really streamline the process, make your life easier, and then it will sometimes even integrates into tax softwares and things like that. It makes it really, really easy for us. And so basically, like Kyle was saying, at the end of the day, it's all about communication. Make sure you're communicating with your CPA. Make sure you're communicating with your investors consistently throughout the whole year so that we're all on the same page. Thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.